Good morning, dear listeners. Welcome to Linas Agro Group meeting with investors. I'm Emilia from Nasdaq Vilnius, and I'll be moderating today's event. We will start with a presentation from the management, which will be followed by the Q&A session. Please be informed that this webinar is being recorded. As always, I encourage every one of you to ask questions during or after the presentation in the Q&A section. The Q&A section allows to ask questions in the anonymous way too. With that said, I'm pleased to introduce today's presenter, Chief Financial Officer Mažvydas Šileika. Mr. Šileika, please, the floor is yours and good luck.
Good morning, everyone, and thank you for joining me during this morning. My name is Mažvydas Šileika. I'm the Chief Financial Officer of Linas Agro Group, and I will present the financial results of 9 months for financial year 2021-2022. As a small snapshot of the group, how we are doing after 9 months of this financial year. And we can say that we have crossed 1 billion in terms of consolidated revenue, and we posted 1.3 billion in consolidated revenues for 9 months of the financial year. Our EBITDA adjusted to IFRS 16 stands at 64 million euros, and our balance sheet is around 894 million euros, which is also a very big increase if compared to the last year. We maintain a strong capital ratio of 26%, and we traded a record high 2.9 million tons of various soft commodities. We don't have any big changes in our storage capacity, and it stands around 564,000 tons of storage capacity. And there are no big changes in the hectares of arable land we manage or we own. We own roughly 6,000 hectares of arable land, and we manage around 18.3 thousand. Regarding the structure of the group, there were some changes during the period of 9 months. We have consolidated 3 elevator companies in Lithuania to optimize our activity, as well as to aim for some efficiencies in management and coordination between the companies. We also merged 2 companies in Russia. We owned, with the acquisition of Kauno Grūdai, 3 companies in Russia. After the 9 months, we currently have 2 companies there. We also merged Žemuogių Turto Konsultacijas and with Linas Agro Konsultacijas. So we're trying to optimize the group structure as much as possible. Currently, the companies in Russia and Belarus are classified as assets held for sale. We have made a decision to sell the companies, and you can see that also in our structure and going forward. I will briefly take you through the segments of the group. We maintain the same 5 key segments, and products and services for farming is the high flyer of the year. You can see that in terms of revenue, it has increased 19%. However, in terms of operating profit, it has a very nice steep upward trend. It increased to 37 million euros, or almost 95% year on year. And the main drivers, of course, are acquisition of Kauno Grūdai, where we acquired quite a significant portfolio of fertilizers, fertilizer trade, seed trade, plant protection, but as well as quite a good trading environment for this year. It is quite challenging. However, due to the inflationary pressure and lack of product in the market, there is quite a nice upward trend. I have to mention as well that the machinery sales are doing also really very well, and we're probably looking to a very good last quarter of this financial year for this subsegment as well. Agricultural production We have a slight increase in the revenues of this segment, which stands at 32 million euros, and the operating profit of this segment is around zero, which is actually good. Zero is good because this means that the profit estimates we made in June last year actually are close to the actual earnings of this sub-segment. Grains, oilseeds, and feed maintains the biggest revenue share of all of the segments, and it increased by a very high percentage. It's 63% year on year. And after a quite devastating 6 months of the financial year, as planned, the profitability of the segment has been restored. And we have now a nice profit of 11 million. And this is a 28% increase year on year. Food segment has taken a much more significance in the overall portfolio of businesses we own and manage. It has now a revenue of 244 million, which is a 18% increase. However, due to very unfavorable conditions in the poultry subsegment, we posted a operating loss of 7 million euros, and this is a minus 90% year on year. I will go a bit deeper into the mechanics of each of the segments in separate slides, and I will comment on the underlying assumptions and possible forecast for the year end. The fifth segment is comprised of very different businesses. As you can see, they do deliver a 28 million revenue or sales. It's a slight increase of 2%. However, the operating result of the segment is around or close to zero. The main highlights of 9 years for 2021-2022 financial year is, of course, the elevated sales, which is driven both by the acquisition as well as very high commodity prices. You can see the structure of our business portfolios has changed, and we are now more diversified as well as stable in terms of profitability and revenue. We can see, as management expected, even though with the extra debt we have taken for the acquisition, we see a decrease in leverage, which stands at 3.4 for a rolling basis. Probably the main topic or the main challenges we faced and we still face, but we faced that during the 9 months of the financial year is the war in Ukraine. And the group has exposure both in the country, which is torn by the war. We have a company in Ukraine. It isn't actually a representative's office, and we don't have any significant balance sheet or sales exposure there. The activity is ongoing, and we continue to take it or to continue the activity for foreseeable future. However, group has also exposure in Russia and Belarus, both in terms of companies we acquired with Kauno Grūdai, as well as with terms of our trading relationships with those countries. In terms of sales revenues for the 9 months of this financial year, we have sold goods and services for Russian entities in terms of 91 million, which is close to 7% of total revenue. But it is very important to emphasize that almost 82 million of that figure comes out of sales of companies who are based in Russia. So around 9 to 10 million are sales from Baltics to the eastern part. The same goes for Belarus entities. We have sales for Belarus counterparties in terms of 25 million euros. It stands around 1.8 of total revenue. And out of that, 22 million is our sales made by entities in Belarus, the companies we own there. So only a minor share of sales is done by our companies from Baltics to those areas. In terms of our balance sheet exposure, it is quite insignificant in terms of overall balance sheet of the group. Trade and other receivables from Russia stands at 0.7 million euros. And in Belarus, even smaller number, which is not very significant in terms of the whole balance sheet of the group. Trade and other liabilities are even smaller. It stands at 200,000 for Russia and 400,000 for Belarus. So the exposure is really manageable. We see that there won't be any significant exposure for the group for this financial year. In terms of the future year, of course, this is a challenge for the group to reorientate part of the sales and part of the sourcing we do in those countries to other regions. Management has decided to dispose the Russian and Belarusian business. So the entities and the assets and liabilities they represent in the balance sheet were classified as assets held for sale. It stands around 29.6 million euros. And also management has made a estimation what is the possible price of these entities, and we had to account an impairment on these entities at around 2.8 million euros, which is already accounted in the 9 months of this reporting period. To give you a brief update, we are currently under a due diligence for these companies. And if the due diligence is successful, we will have a firm offer, and we suppose to close, or we're planning to close the deal, which we have communicated previously, by the end of the financial year of the group, so meaning by the end of June. However, this is a very complicated process. It's quite encumbered by different regulation and other obstacles. However, we hope to finish the deal by the end of the financial year, at least in part or in full. The next slide shows the dynamics of our gross and operating profits. I will start from the left-hand side of the slide, where we have a representation of our gross profit, and you can see that we have a very healthy increase in sales of almost 200% or twice, and we reach 1.3 billion in terms of revenues. This is driven by the acquisition as well as the increase in overall prices. So meaning that the group is expanding both ways. The biggest share of the sales still are attributed to grains, oilseeds, and feed. However, you can see that the food products take a higher proportion of the sales now. And the products and services for farming, of course, this is the year where we can see very significant result coming from this segment. Probably the highest highlight, or the biggest highlight of this dynamics, is the gross profit margin. We have seen an increase of it to 7.6%, and we haven't seen such a high level for the last 5 years or so. So this is also quite a big of achievement for the group. If we move to the right-hand side of the slide, we can see the dynamics of the operating profit, and we see a very, very high increase in the operating profit, which is mainly driven, of course, currently or for these 3 quarters by the products and services for farming. However, the profitability of the grain, oilseeds, and feed has been restored according to our estimations and plans. However, even though we now have a more diversified food portfolio, due to the pressure of the poultry part of the food portfolio, they generated a loss of 7 million. So even though we have a very nice figure of 39 million for the 9 months of this financial year. And the highlight of operating profit dynamics is that we have managed to increase the operating profit margin to 2.9%. And this is quite a challenging aspect of our financial year, as we have quite a lot of pressure coming from the wage inflation, other cost inflation, and this is actually a very good achievement we see in comparable to the market as well. This is a slide which shows how the group has changed year on year. So we're comparing the 9 months of last financial year to the 9 months of this financial year. And if we take it from the left-hand side of the slide, we can see that the revenue part or the revenue mix has really changed in the group. Even though grains, oilseeds, and feed has posted a 60% increase in sales, we see that overall in the portfolio of businesses, it has decreased to 63% versus 75 last year. And this is mainly due to the increase of share of sales mainly in food products, as well as products and services for farming. And this is one of the achievements we were looking for when we were doing the acquisition. So I expect to see even a more healthy mix going forward in terms of sales when we compare the segments going forward. When we look at the gross profit dynamics, we see that the overall change is also visible, that we have a very high increase in products and services for farming. This is, of course, the year where they are performing the best and have increased their share. However, we see a decrease in the trading part to 29% versus 38%. And the food production is more or less stable due to the challenges which we actually see with the poultry. Even though other businesses in this segment, which are flour mixes, breadcrumbs, instant noodles, are doing really well. They are profitable segments, profitable businesses. However, they represent only a third of overall revenues, which then translates to gross profit and operating profit. So even though we have a third of the segment performing profitably due to the challenges in the poultry, we have overall a negative effect on the operating profit, which actually shows in the bottom part of the bar charts. Operating profit comes mainly for the 9 months from the products and services from farming and grains and oilseeds, and then we have a negative effect coming from the food and food products. Our balance sheet changes are actually mainly connected with our debt level. Overall, the balance sheet composition remained the same, or more or less the same. The balance sheet has increased almost double in size. However, the composition is more or less the same. We still have the majority of our balance sheet coming from current assets, and these are mainly inventory and trade receivables. The biggest part of inventory is readily marketable inventory, which are exchange traded commodities. And the majority of the debt is actually connected with them. Capital ratio remains solid at 26% as for a trading company, and 12 months adjusted pro forma EBITDA on rolling basis stands at around 8.5 million euro, which gives a net debt EBITDA at 3.4. So having a 3.4 for 9 months of the financial year, when we are still quite high on our stock as well as debt, is actually quite a good sign. We expect that to decrease further for the full financial year. Group has total committed facilities for financing, manufacturing and credit lines at around 350 million. We are fully financed for this financial year. We made investments in amount of 14.5 million. Around 10 to 11 million came through other segments, and around 3.5 came from food segments, and especially poultry. So poultry comprised around the 20-25% of the investments overall. I will go a bit deeper into each of the segment. I will give you a small overview as well as a possible trends for the full financial year. As you can see that uh, products and services for farming and all the categories in this segment have posted really nice growth in terms of sales. So we see all the positions are edging upwards, and we have a very high increase in certified seeds, which stands around at 96%. Fertilizers sales increased almost double. Plant protection and trace more to almost 300%, and grains facilities and farm equipment almost 90%. Agricultural machinery spare parts, it has a healthy increase year to year. It's almost plus 27% and plus 14 respectively. And we expect a very, and it's historically quite evident that the last quarter of the financial year is even stronger for them. It's quite important because we have a very healthy activity for the end of the financial year and for before the season when you take the crops. What I would like to emphasize are the fertilizer sales and plant protection sales. This is, of course, driven by the quite nice acquisition effect that we acquired a significant portfolio of customers with Kauno Grūdai, as well as they were actually in some parts even more into these segments, meaning fertilizers, where we have actually increased more than 2 times our market share. So the result of these segments or these categories have been driven as well as by the economic activity. Farmers willing to invest into the harvest. There was a lack of the product, and we were working in an inflationary environment. However, also from this intensity or in terms of volumes we have sold for the farmers this year. So you can see that sales were edging nicely, and we have a by far probably record high operating profit for this segment going forward for this year. Main challenges for this segment is of course the supply of fertilizers. Before the war, before all the sanctions, the main suppliers were Belarusian and Russian entities. Now we're actually reorientating our portfolio to other suppliers, and this takes time. It has proven to be a bit more cumbersome. It has more logistical issues. However, we deem to be successful because this is a big shift for the overall market. And we see that there are possibilities to reorientate the supplies from other suppliers and other geographies going forward. If we look to the agricultural production segment, there are no big changes in this segment regarding how much arable land we manage or the agricultural companies we own. You can see that the crop production sales have increased by 7%. And milk production sales are up by 32%. Main message from this segment is that we have healthy prices for raw milk, which even with the inflationary pressure we face this year, gives a good result for the segment. And as I mentioned before, the segment is also quite difficult to evaluate during the interim quarters, but we expect for the full financial year to post quite good results for this segment, as all the conditions are there. Milk prices are healthy. We sold the crop for the price we were more or less expecting for the last year harvest. And looking to the this year harvest, it looks really fine. The condition of the crop is good or either very good. We have enough humidity, and the sowings were done according to time, and we have fully prepared for the season in terms of fertilizers. So we deem to expect another successful year for the agriculture production segment going forward. Grains, oilseeds, and feed, the biggest segment in terms of sales. The biggest change or the biggest mix of the portfolio also came to this segment with the acquisition of Kolmogul Bay, because now we're not only the trader of grains and oilseeds, but we also are a significant or one of the biggest producers in the Baltics of compound feed and premixes. So this segment includes the result from compound feed and premix production, as well as trade of feedstuff. And this gives as well more stability and extra profitability coming from this segment. And as you can see that we have a healthy increase in sales in terms of trading activity of grains and oilseeds, as well as a more than double increase in compound feed and feedstuff sales. This actually brings attention to my previous point. This segment is also challenged by the current situation we face with the war in Ukraine and the decision by the group to exit businesses and suppliers from Russia and Belarus, because part of the feedstuffs and soft commodities were sourced in Russia and Belarus and traded to the partners in the Western Europe, Scandinavia. So we are reorientating our business and our suppliers, searching for new trade flows, which we can change. However, of course, part of that might not be restored and changed tete-a-tete. So we might face challenges next year for this segment. However, the trade of feedstuff and soft commodities from the Eastern countries did not represent a very significant part of this business. It is a significant part in terms of sales. Of course, it brings gross profit and operating profit to the table. However, trade of Baltic grain and Baltic oilseeds or production of compound feed compromises of the majority or represents the majority sales and profit from this segment. So we will see how it goes for the next year. However, it will face challenges. The segment will face challenges next year going forward. Food products, I talked about the challenges in food products a little bit. I touched upon it. So as you can see here, we have mainly three categories in this segment. So it's poultry meat production, flour mixes, and breadcrumbs. And then we have instant foods, which are instant noodles and porridges. And because these are very new businesses, we still don't have a benchmark for them. However, sales of poultry meat increased 250%. And we have, when we acquired the Kolmogul Group, we also acquired a very significant portfolio of poultry production, which is Vilnius Paukštynas and Kaišiadorių Paukštynas. So even though we have a very big increase in terms of sales, and we have a third of the sales coming from other segments than poultry meat production, overall the segment posted a negative result for the 9 months. And this is mainly due to the sharp increase in energy prices. Poultry production is a very big consumer of energy, especially natural gas, because breeding of broilers require to keep them in quite high temperatures, around 32 degrees. So we have had a very big spike in the energy prices during the cold period of the year, which actually is covered by the 9-month results. We also have a very high increase in the feedstuff prices, because you can see that the prices of grain, other proteins, meals have increased a lot. And this is also a big pressure on the cost of goods sold. We have also been in a situation where the closest substitute, pork, was quite cheap during this period, and consumers tend to switch between pork and poultry depending on their price as well, and their consumption preferences, of course. So, giving all the circumstances around the segment, even though we put quite a lot of effort to optimize, we moved part of the slaughtering operations to Vilnius Paukštynas. We closed Kaišiadorių Paukštynas. We are trying to gain efficiencies and economies of scales in our production, and we try to see the three production plants, two in Lithuania and one in Latvia, as one to gain the maximum effect. However, the cost of goods sold increase or hiking energy prices and feedstock prices were very hard to adjust during the 9 months. Looking forward, due to natural decrease in energy consumption, due to warmer weather, and due to the increase in final product prices, we expect the last quarter to be profitable for this segment. However, profitable I mean for poultry segment. However, it probably won't be enough to change the direction of this segment for the full financial year. We expected it to ease out or to decrease the negative operating profit. However, it is still hard to say if it will be significant enough for the full financial year. And this was the full overview of the financial standing of the group. I hope it was useful and interesting for you, and I will be now ready to take your questions.
Thank you very much for your presentation, and let's proceed with the questions. But before that, I would like to remind all the attendees that you can send in your questions in the Q&A box, and they will be answered. So let's start, and the first question would be as following. Optimization of bird business, how is it going? What decisions were made, and will it shrink quantity of production wise heavily, not revenue? Thank you.
Thank you. I probably have covered a bit of this question already, but I will try to address the other question parts. The volumes or tons we produce will shrink this year, year on year, due to the closure of Kaišiadorių Paukštynas slaughtering house. We cannot move full slaughtering capacity from Kaišiadorių to Vilnius. We cannot basically accommodate that. However, we see that a very natural shift due to the overall decrease in sentiment or consumption of poultry in the market. Not so to say decrease in consumption, however, switching of consumer preferences between other substitutes, meaning pork, as well as switching between different suppliers. We still have a lot of pressure from our competitors from Poland, as well as Estonia. So the decrease in our production, in our review, comes really naturally, and we see that in this occasion, less is more in terms of our profitability, because we will achieve more efficiencies, cost savings, economies of scale operating one slaughtering house in Lithuania. However, the full effect of cost savings will come more towards the next year. However, because this year accompanies more of the costs we have to bear to close the slaughtering house. So next year will be evident the full effect of cost savings from this action. And the other parts, answering the other part of the question, is that we see that it might actually, as I mentioned before, not be enough for this year to have a successful last quarter to change completely the direction of this segment for the full financial year. However, due to the lower energy requirements, we see that it will be more profitable going forward. Thank you.
Thank you for your answer. Another question would be sales of companies in Russia, Belarus. At what stage is this? What will be the profit loss if known yet? And how will this and the Ukraine situation in general will impact revenue and volumes of production operated? Thank you.
So yeah, I can emphasize that we are now undergoing due diligence, and if the due diligence is successful, we go to a firm offer and SPA negotiations, uh, and I hope that we will work according to our timeline, which we communicate, and we hope to close the deal by the end of the financial year, meaning by the end of June. We have management has estimated the possible effect on the financial standing of the group due to the sale, and we have already accounted that in our 9-month results. The effect is an impairment, a negative impairment of 2.8 million euros, and we expect it not to change significantly. In terms of revenues, so we will lose the revenues which we now have in terms of Russian entity sales, which is around 81 million for 9 months this year, and 22 million in Belarus this year. Of course, there is another part that we were sourcing soft commodities and feedstuff from those geographies, which we are trying to reorientate next year. So we will have to search for other trade flows and other suppliers around us. Ukraine is one of the potential ones. We're actively working with Ukraine and actually swapping the other Eastern suppliers with Ukraine. So the total effect of sales might not be that big in terms of our consolidated group revenue. In terms of balance sheet, we will sell around 29.6 million in terms of assets and similar in terms of liabilities. So overall, the effect is manageable, and the management feels that we will be able to withstand it and weather it out through changes in other businesses, trade flows, and other geographies.
Thank you for your answer. We are receiving quite a few questions, so let's proceed. And the next one would be as following. What segments will be the drivers of the business of the company in 2022-23 financial year? And do you expect the profitability of products and services for farmers segment to stay at such high profitability levels? Thank you.
It's a very, very good question. It probably would be really good to see how will the geopolitical situation develops, and what are the full effects of war and how long it takes, in current situation. But of course, next year will be challenging, and it will be mostly challenging for grains, oilseeds, and feed trade, because the situation is really volatile. The prices are really volatile, and any movements regarding the Ukrainian grain stock, crop stock, it changes the market in one or the other direction. So this is a very big unknown factor. However, the sowings and the crop season in terms of the Lithuanian or Baltic geography, at least for now, looks fine. And it gives a positive look forward that overall the Baltic grain trade might be successful in terms of volumes. However, there is a lot of volatility in the markets in terms of prices and buyers, potential buyers, and so on. So grains, oilseeds, and feed really has challenges looking forward. Agricultural production probably now is the segment which gives more comfort, at least for now, looking at the crop situation, looking at the raw milk prices. If these conditions remain, because we have still quite a long period, almost 2 months or a month and a half before we start the harvest. But if these conditions remain, I think we have a good backbone for the agricultural production segment for the next financial year. However, I really want to emphasize that it might change every time we have changes in weather, which is also, something we cannot really control. Products and services for farming, of course, this year is really extraordinary. I really would like to emphasize that that management doesn't take it for granted, and we don't expect to have it in the same high level. Because due to the challenges we have in terms of fertilizer supply. We will see how that goes, how the market sentiments, meaning the farmer sentiments in terms of fertilizer buyings, acquisitions will go. Because we are doing a really big shift from supply from the east to the supply from the other parts of the world. We will see how that goes. We are currently undergoing this process. It looks that we are doing our best and we find alternative suppliers, which is already good. But we will see how that will fit with our farmer expectations in terms of price and other parts. However, this segment will be much more visible in group's portfolio, because as I mentioned before, we acquired quite a significant part of portfolio of our customers, farmers with Kauno, who we have incorporated in overall our sales, and we do sell more now in terms of plants of fertilizers or plant protections than we used before. So we here have a quality as well as quantitative increase or development. So we will see what will be the level to settle in. It's quite hard still to benchmark, because the group is going through a very big transformation this year. As you probably can see, the increases year to year are very high. Some are driven by naturally the acquisition or volume increases. Some are driven, of course, by the market conditions as well. The food segment is probably one of the most challenging ones, because it's really hard to predict the energy prices going forward. For the warm part of the year, where we have natural lower consumption of energy, we see some positive signs that current adjusted product prices makes us profitable. However, it's very hard to estimate what will be the natural gas prices, electricity prices, and feedstock prices for the other half of the year. Feedstock prices are really very impacted by the global movements and the Ukrainian war as well. Natural gas goes the same. We are applying different strategies. We are looking to hedge or the fixed prices in some extent, and we're doing other efficiency changes in our poultry production, that we would be lower in terms of energy consumption, in terms of gas consumption, to decrease it. And we will see how much of that we can already achieve for the next financial year. But overall, food segment remains really challenging due to then the predictability of feedstuff and energy prices. So that would be probably my expectations and forecast for the next financial year.
Thank you very much for the comprehensive answer. And now we have another question, and it's asking, so which globally listed company could be similar to Linas Agro activities portfolio? Thank you.
Yeah, probably it's hard to find a company similar to Linas Agro, but when we benchmark ourselves, we look at companies closer to our region. That would be Linas Group in Sweden. That would be a Danish agro group in Denmark, or DLG in Denmark. If we look more to the global context, Of course, these big corporations and companies as Archer, Daniels, Midlands, or Bunge are more or less doing similar activities, but they have other priorities and other emphasis in their business portfolio. They are, of course, much bigger and they operate globally. However, these are companies operating in agricultural, food, and global nutrition sectors, which are part of our sectors as well. So these are probably more or less similar companies in some extent to us.
Thank you. What was the reason for such a high profitability in products and services for farming? What factors contributed to it? Thank you.
Two drivers: increase in volumes we traded, and these are due to the acquisition of Kauno and overall market sentiment. Volumes increased nicely year to year. And of course, plant protection and trace products goes the same story here. We have increased in volumes due to the acquisition and due to the larger portfolio of customers we now have and we can reach. The other part is that we were working under really inflationary conditions this year, as well as of a lack of product or lack of supply due to the changing conditions due to sanctions during this year. The activity of farmers was also very healthy, and these are probably two drivers. Farmers were willing to secure products for their farms due to the rising prices, as well as due to the war. They were thinking a bit in front or forward-looking to secure their supplies for not only this season, but maybe partly for other season a bit earlier than usually. Because the situation is really, hard to predict how it can evolve going forward. So these are where the probably main drivers for this segment this year, which is, both some part of the internal and acquisition decisions we made, part of the conditions of the market and geopoliticals, which were, of course, not in our control.
Thank you. As there is still ongoing search to replace Russian suppliers, could you give some guidance on potential increase in COGC? Is there a risk of local market shortage of some items not being replaced in time? Thank you.
Well, hopefully we're not looking at shortages. We are probably looking at a possible increase in prices, which impact our cost of goods sold. And this is still a very big question, how much of them we will be able to transfer forward on. It's more easy when we talk about exchange traded commodities, because these are exchange traded commodities and you can deal quite openly on this part. We see that there are disruptions in the supply chain. However, we hope that they won't be that big that we could have a physical shortage of some of our inputs. In terms of probably fertilizers, which is also quite a significant segment of ours and a big trade of ours, this is a big market shift. So it's not only about us, it's about the market. And the market overall is shifting, and the consumers, buyers are shifting together, because we need to supply, and we will find alternatives, or the best possible alternatives, best possible products to be changed. We might need to plan more in advance. We might need to take bigger parcels in terms of shipments, meaning we will receive fertilizers now mainly by ships, not via rail. So we need to plan and accommodate a bit in advance. However, we see that as of now, more or less the shift is going according to plan, and hopefully there won't be big disruptions. But the supply chain overall has increased. It's hard to predict how the situation in terms of prices and market supply demand will change in the next couple of months or even a month, because the dynamics and volatility is really very high in the market due to the war and all the geopolitical changes we see. All the possible sanctions, they move the markets, and you see that the sanctions really change quite often. But we are really trying to be flexible, not holding long positions, and we try to adapt to that as much as possible.
Thank you for your answer. Can the profitability of products and services for farming operations continue in the next financial year if fertilizer prices stabilize globally? Thank you.
Probably the trend in the farming segment overall is some sort of a somewhat slightly positive or slightly optimistic, because the grain prices have increased as well with the increase in price of the fertilizer. This means that an average farm, if there were no big mistakes, operating mistakes made, should be profitable or significantly profitable, because majority of the main grains which are being harvested in Lithuania and oilseeds prices really increased during the year. They are high looking forward for the next year. And even you have the inflation or the higher prices of the fertilizers, it still looks economically fine and profitable for farmers to operate. We will see how the autumn sowings will go and what will be the strategies of the farmers regarding the application of the autumn fertilizers. Autumn fertilizer period is not, maybe is less crucial than the spring one. Spring nitrogen fertilizer application is really crucial for the crops, and nitrogen fertilizer is actually something a bit more, a bit less difficult to supply in the market. We have more alternatives for nitrogen fertilizers, which are more crucial and are applied during the spring. So, having said all that, I think that the conditions for the farmers looking forward are still there to be profitable this season. If the weather conditions do not change significantly to the worst part, I think it will be more or less okay, and we're looking at a good season. Next year is still there to be answered, but I think there are possibilities to manage it.
Thank you very much. We have quite a few questions left, so let's continue. And the next one would be as following. How do you see the Q4 for trading segment? Did you already make contracts for all your inventories, or still some balances is left to be sold at current market levels? And do you see similar profitability of the segment in Q4? Thank you.
The forecast for the fourth quarter for this segment is positive. We expect to see growing profitability, and we expect to have a really good result for the end of financial year. The fourth quarter is really still very active in terms of trading, so we still have trading activity, and we still had and have goods to sell this quarter. There might be some carryovers to the next financial year, but they won't be that significant. So to sum up, the fourth quarter for this segment is expected to be good, profitable, and the targets will be reached for the full financial year.
Thank you very much. In a report disclosed that price of poultry meat in Poland has risen by more than 40%. Are all producers in the region struggling with operational profitability, or it is more of Baltic effect? Thank you.
Yes, the profitability struggle is more or less all around the bigger poultry producers, which we can, follow. So this goes the same for poultry producers in Poland and as well in Scandinavia. One of the biggest Scandinavian producers, Scandi Standard, also posted really uh, bad figures for this financial year. However, they were slightly positive, not red figures as ours, due to that moment that in the Baltics we have more competitive pressure than, for example, in Scandinavia, meaning that poultry producers in Poland, usually some in Estonia or Finland, really do dump their overproduction in the Baltics, meaning that their sales here are basically the very high discounts, giving pressure for our prices as well as the choice of consumer. Because the logic behind is really very simple. When you have overproduction and you cannot sell that in your local market, you either freeze it and export it somewhere far away, or you choose to take quite a high discount, but still not that big as for frozen production, and sell it in the geographies nearby you. So meaning that the poultry producers, for example, in Poland, do really discount their production, which they sell here in Lithuania, for example. There are a lot of other factors as well why sometimes they choose to discount the production. However, in here in the Baltics, we really have the very big price pressure coming from this. And of course, when the price differences are that big, consumers tend to choose other products rather than ours, which is a bit different in, for example, Sweden or Germany or France, where consumers try to prioritize local fresh local quality production in terms of export production. So this is a challenge going, a bit more than only the feedstuff and energy price increases.
Thank you for your answer. What is the group's long-term debt to equity goal, excluding short-term credit for working capital needs?
So I will maybe illustrate that through our debt to EBITDA level. So our long-term debt to EBITDA level on 12-month rolling basis stands at 1. And we think that we are, not aiming to have more than 2.5 at any time of the period, meaning whenever we do the investments or we are expanding. As of now, our aim is to have 2.5. Our net debt EBITDA level, which is now 3.5 on 12 months rolling basis, is of course now on the lower side. It's hard to contain it in this kind of level because our balance sheet increases really much, during the intensive trading periods, meaning Q2 and Q3. But when we adjust it with readily marketable inventories, and we are now following this KPI as well, it stands at around 2.5 maximum, which I think is a really healthy number, and it's comparable with the other traders in the market. 26% of our capital ratio is probably somewhere in between where we are aiming to be. But I think something around 30, more than 30, might be hard for the group to achieve, basically due to the composition of our balance sheet. We have quite a lot of inventory and short-term assets which are moving through the year because we are a trading company. We need to buy everything on our balance sheet and then sell it during the year. That's why we use quite a lot of working capital facilities and we need the working capital. We especially now need quite a lot of equity to finance ourselves as well, not only banking loans, because our working capital is increasing. So we are increasing our financing facilities by our bank partners, but we still need to maintain the leverage level or the leverage we are financed by the banks. So we need to contribute more equity as well. So to be conservative on the balance sheet, to be conservative on the future management of the group, we need to maintain a healthy level of equity and retained earnings in the group going forward due to the very high level of volatility in the markets and the inflationary price increases.
Thank you very much. And we have the last question for today, which is as following. As you explained, higher volumes was the reason behind the increase in absolute profits for products and services for farming segment. But what led to increase in profit margins? Was it higher selling prices or lower cost? Thank you.
Yes. So I mentioned two reasons why the result is so good. So volumes and then the profit margins. Profit margin drivers were increase in prices. Cost of goods sold, it increased with the market. However, due to the really big demand for products and services for farming, due to the inflationary pressure, farmers were trying to buy and secure in advance, as well as the geopolitical situation and the security of supply. It also meant a higher buying, higher activity, which also led to higher prices for a given period.
Thank you. As all the questions are answered on behalf of Linas Agro Group and Nasdaq Vilnius, thank you everyone. It was our pleasure being with you today. The recording of the presentation will be available in the company's website and Nasdaq Baltic YouTube channel. Thank you very much for the informative presentation and have a good day everyone. Goodbye.
Thank you very much. Bye.